Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today to whap and tap on your head with another ADH wealth solution. Today, I'm going to be talking about how life insurance is the most coveted asset on Wall Street, not those flashy investments they throw at you guys. But before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description of this video. So, how an insurer in Iowa became the most coveted asset on Wall Street. American Equity's chief executive battles to keep annuity provider independent as acquirers circle. The man of the moment in private capital is not anywhere near New York City. Rather, Anant Bahala is based in sleepy West Des Moines, Iowa, running a retirement annuities purveyor that is captivating Wall Street's savviest financiers. American Equity Investment Life Insurance last week rebuffed an unsolicited $4 billion offer from rival controlled by Paul Singer's Elliott Management, capping a tumultuous year during which Bahala also antagonized his company's largest shareholder, Canada's Brookfield Asset Management. Underpinning the boardroom drama is Bahala's determination to keep AEL, one of the few independent annuities operators left, out of the wave of consolidation sweeping through the industry as private equity groups hoover up insurance assets. So again, all these people telling you buy term, invest the difference, the investment companies are going to buy insurance companies. Just something to think about. The bad blood between Bahala and Brookfield is a product of a deal that AEL entered into November with startup fund manager 26 North, funded by the former longtime Apollo Global executive Josh Harris. Bahala first turned to Brookfield in 2020 as it sought a white knight to fend off early hostile bid from Apollo, where Harris worked at the time. Now, with the Elliott bid out in the open, AEL and its $70 billion of assets are in the crosshairs as a clutch of Wall Street investment titans circle the company. Apollo, Brookfield, KKR, Carlyle Group, Ares, and Sixth Street are among the many groups that could be bidders in the potentially frenzied auction next year. AEL is the last remaining independent standalone fixed indexed annuities player of scale. Daniel Bergen, an equity analyst out of Jefferies, wrote in a recent note to clients. Our sense is that there continues to be strong demand from alternative asset managers looking to grow in the fixed indexed annuities space. The looming descent of the masters of the universe upon Iowa might sound incongruous, but it would not be an anomaly. Private equity groups that once specialized chiefly in leveraged buyouts have made debt investing the key pillar of their efforts to grow their asset bases to reach trillions of dollars. Building and acquiring insurance operations has proven to be a preferred method for private equity groups to find steady, permanent capital derived from the premiums paid by policyholders, which they then invest in newfangled credit securities before paying out to customers years later. Bahala has so far convinced AEL's boards and its shareholders that the company can go it alone despite the whirlwind of deal-making, arguing that he had mastered the financial engineering needed to build a standalone private equity-style insurance company, or insurer. But his desire to keep AEL independent is set to face its biggest test yet. It's a game of chess. His strategy on paper looks interesting, but is hard to execute, said one private equity executive not involved in the bidding. Bahala is among those financiers that believe annuity providers need to move beyond vanilla bond investing and plow capital into exotic debt securities, which proponents argue are just as safe while yielding higher returns because they are complex and illiquid. This is the strategy that was pioneered by Apollo when Harris worked there. It bought a troubled block of annuities from AEL in 2009 that would eventually form the foundation of its Athene annuities business. Apollo's wager was that both annuity sellers and policyholders could benefit if premiums were more aggressively invested. Bala landed the chief executive job at AEL in early 2020 after stints at MetLife and AIG, where he had become a close ally of Peter Hancock, the longtime JP Morgan executive who had taken the helm of the teetering insurer after the financial crisis. At MetLife, Bala was heavily involved in separating its retail life insurance business into the publicly traded Bright House Financial, where he became finance chief. Anant is very smart. I describe him as a technician who was good at creative ideas, said the private equity executive. He's done a fine job. Some people would say he's sometimes a little too smart for his own good and less practical. Within months of joining AEL, Bala's ambition would be tested by unsolicited bids from not just Apollo, but also Mass Mutual. It was at that point he decided to sell a stake of almost a fifth of Brookfield to fend off the suitors. At the same time, Bala unveiled a new strategy he dubbed AEL 2.0 that he said would boost shareholder returns rather than selling out to a private equity group. AEL will contract investment management out to multiple managers with specialist expertise. Since then, the company has struck deals with groups including Premium Partners, Adams Street, and Monroe Capital. AEL says nearly a fifth of its assets are now invested in private capital, helping nudge up its annual investment yield to 4.3% from 4% in 2020. In an interview with the Financial Times after the Elliott bid, Bala said this is so-called open architecture was best for policyholders because it means that assets are managed based on merit and market opportunities. Separately, AEL is trying to push further into the reinsurance business to boost equity returns. It is this that appears to have irked Brookfield, which cut a reinsurance deal with AEL when it first acquired its stake. Under that arrangement, Brookfield paid a fee to AEL in exchange for the transfer of billions of dollars of liabilities that Brookfield wanted to invest. The row erupted in an unusually dramatic fashion in November, when analysts on an earnings call started peppering Bala with questions about why a Brookfield executive on AEL's board had abruptly resigned. Bala struggled to answer because he just found out. The securities filing containing the news was made public while the call was in progress. In a letter explaining the defection from the board, Brookfield's departing board members said that there had been a fundamental change in the strategic direction of AEL. So, ladies and gentlemen, I'm not going to read the entire article. I'll finish it. Why not? That strategy change was the new agreement with Harris 26 North, under which the two companies signed up to a reinsurance partnership. AEL also bought a stake in 26 North, the size of which has not been disclosed. Since pulling its representative off AEL's board, Brookfield has demanded that the Iowa company make public the process and terms of the 26 North deal. The suggestion is that Bala has unwisely partnered in what Brookfield believes is an unproven venture by teaming up with Harris. However, Bala recently told investors that the 26 North transaction was a sideshow and that the real reason the parties fell out was because Brookfield had in May acquired a rival insurer and thus became a direct competitor of AEL. You can come to your own conclusions about Brookfield's motivations, he added. Regardless of who is right, the public boardroom bust-up has put AEL in the spotlight and into play. On December 8th, Elliott's life insurance affiliate Prosperity Group submitted the $45 a share offer that has been repeatedly rebuffed by AEL as opportunistic. A person involved in the situation said one large private capital manager told Prosperity it was pleased that it had put AEL in play, indicating its own interest in pursuing a bid. In late November, AEL granted Bala 1.2 million new shares that vest at stock prices between $45 and $60, an aggregate award that could eventually be worth more than $70 million. Selling the company at $45 per share would mean missing out on the full windfall. So, ladies and gentlemen, the article will be in the description as well. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. With that being said, wipe ass. work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.